Coming up on Market to Market, one lawmaker comes up with a novel approach for the next farm bill. Record weather disasters stretch federal, state, and local budgets to their limits. And the EPA says a popular and controversial method of oil drilling may be polluting groundwater. Those stories and market analysis with Walt Hackney and Virgil Robinson next.
Funding for Market to Market is provided by Pioneer Hybrid, working with growers to help put the right product in each field. Pioneer, science with service, delivering success. This is the Friday, December 9 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mark Pearson. Rally caps were the order of the day on Wall Street Friday after European leaders announced new commitments to resolve their debt crisis. All 17 nations using the euro agreed to sign a treaty giving a Central European authority closer oversight over their budgets. The Dow Jones Industrial Index rose nearly 190 points on the news and settled Friday just below a 6-week high. Bank stocks led the market higher, reflecting easing anxiety over U.S. exposure to the debt debacle in Europe. Citigroup rose nearly 4% Friday, while Morgan Stanley rallied 3%, and Bank of America moved more than 2% higher. Lest they get too puffed up, members of Congress would do well to remember that a lack of consensus on how to rein in their country's debt has the U.S. careening towards sweeping budget cuts in 2013. And hoping to preserve some government support for agriculture, lawmakers have come up with a novel approach for the next farm bill. Only weeks after the 2012 Farm Bill talks collapsed amidst a supercommittee failure, the omnibus legislation could find itself tied to a new Washington initiative. Farm state lawmakers, including House Ag Committee ranking member Colin Peterson, have proposed adding the next farm bill to payroll tax and unemployment insurance legislation on Capitol Hill. The move would once again marry ag program funding to a political hot potato, with potential backing by the Obama administration. Peterson contends the unlikely legislative marriage would allow $23 billion in agricultural cuts over 10 years to offset costs for immediate unemployment and payroll tax cuts. Agriculture would then be immune from mandatory across-the-board cuts in 2013. Mandatory spending cuts were triggered by the supercommittee's failure to reach a debt reduction compromise in the days preceding Thanksgiving. But Peterson's new plan to resurrect future agricultural spending concessions to blunt near-term cuts faces an uncertain future. Congressional Republicans have yet to outline specific terms for a payroll tax cut compromise, and many may not want to blur the lines between political party orthodoxy and farm state affiliation. Furthermore, congressional agriculture leaders Debbie Stabenow of Michigan and Frank Lucas of Oklahoma have yet to publicly sign onto the Peterson plan. If Peterson's latest move is any indication, many farm state lawmakers continue to fear an election year budget axe could wield substantial pain from government farm programs. Peterson conceded this week that a big, huge floor fight over agricultural policy may be unavoidable in 2012. Congressional leaders announced this week the Farm Bill process will restart in late January with fresh hearings. The Environmental Protection Agency announced this week a popular and controversial method of oil drilling may be polluting groundwater. Hydraulic fracturing, or fracking as it's more commonly known, involves pumping pressurized water, sand, and chemicals underground to open fissures and improve the flow of oil and natural gas. According to EPA, compounds likely associated with fracking have been detected in groundwater beneath Pavilion, Wyoming, where residents say well water reeks of chemicals. Environmentalists characterized the report as a significant development, though it was immediately criticized by the oil and gas industry. Ultimately, the development could become a big fracking problem for policymakers trying to balance the merits of domestic energy production with their obligation to protect constituents. But a bigger threat to public safety this year may have been record-breaking weather. Mother Nature smashed the record for U.S. weather disasters this year as losses in a dozen calamities exceeded the $1 billion mark. The National Oceanic and Atmospheric Administration, or NOAA, reported this week that total losses from the deadly dozen alone piled up to a staggering $52 billion, matching the total for all of the 1980s, even when adjusted for inflation. Tornadoes accounted for half of the record-breaking disasters as a steady stream of lethal twisters roared across dozens of states, claiming the lives of more than 1,000 people and inflicting nearly $28 billion in damages. Other natural disasters also devastated large geographical areas this year, particularly in the southern plains, where record-breaking drought decimated crops and livestock. Damages from the arid conditions are estimated at nearly $10 billion, and that figure does not include more than $1 billion in losses due to wildfires in Texas, New Mexico, and Arizona. Where it wasn't too dry this year, there's a good chance it was too wet. Flooding caused significant damage along the Mississippi and Missouri rivers. A levee along the Mighty Miss was intentionally broken near Wyatt, Missouri, in an attempt to protect the Illinois town of Cairo. Other levees failed after being weakened by flooding along the Missouri River, which in some cases lasted for months. And when combined with losses due to epic flooding along the Mouse River in Minot, North Dakota, America's swollen waterways racked up more than $6 billion in damages. Not to be outdone by tornadoes, droughts, or floods, Hurricane Irene slammed the East Coast from the Carolinas to as far north as Vermont, killing nearly 50 people and leaving more than $7 billion in damages in her wake. Scientists blame the rash of severe weather on an unlikely combination of global climate change and freak chance. The Federal Emergency Management Agency has been inundated with calls for assistance, and when it comes to weather issues in 2011, the only thing in short supply is money for disaster relief.
Next, the market-to-market report.
Wheat prices headed south this week while corn traded sideways. For the week, March wheat declined 30 cents while the March corn contract gave up a penny. Soybeans trended lower as well as the January contract declined nearly 30 cents while nearby meal prices were down $11.40 per ton. In the softs, the March cotton contract lost $1.40 per hundredweight. And in the dairy market, January Class 3 milk futures gave back last week's gains with a loss of 36 cents, while the February contract moved 17 cents lower. In livestock, the February fed cattle contract lost $5, as did nearby feeder cattle, and the February lean hog contract lost nearly $3. In the currency markets, the euro rallied Friday, but settled with a weekly loss of 33 points against the dollar. Crude oil was down more than $1.50 per barrel, and COMEX gold declined $34 per ounce. And the Goldman Sachs Commodity Index lost more than 6 points to settle at 647.60. And here now to lend us their insight on these and other trends are two of our regular market analysts, Virgil Robinson and Walt Hackney. Gentlemen, welcome back. Thank you for being with us. We appreciate it.
Hello, Mark.
Happy holidays. Well, we didn't get much of a present from the USDA on Friday, Virgil. A little bit of a disappointing report as interpreted by the grain markets, although Walter is smiling about it. What's your interpretation?
Well, Mark, I thought the data was most bearish with respect to wheat, and then secondly, soybeans. And surprisingly, wheat futures closed steady higher on the day, not higher on the week. But certainly that would suggest to me a lot of this supply discussion has been factored in, Mark. Price discovery has done its work. So oftentimes there'll be a recovery in price in January, February in wheat futures markets, and I think that might be fueled this year by continued concern about the drought in the southwestern part of the United States. And secondly, the concern that I think will develop and grow with respect to the La Nina event as it pertains to Argentina and southern Brazil. So I better retract that statement. I'm of the opinion there will be some price recovery in soft red wheat as well as the hard red and spring hard red wheat futures contracts in the next couple of months. At that point, then make sales or create minimum price and think about perhaps even pricing some new crop wheat, Mark.
Well, there's no question there's been a huge shift of wheat in the last year over to feeding. Out in Idaho this week, they all confirmed that. We'll get Walt's comment on that too.
Yeah.
But talk a little bit about with that kind of shift and that kind of demand, worldwide, there's still plenty of wheat out there.
Correct, and that was again documented in today's WASDE data. Mark, the crop in Argentina, Australia, Canada, and China specifically all increased month over month. So wheat production outside of the United States was significantly larger year over year, and that accounts for much of the price pressure here in the United States.
All right. Do you have a target, Virgil, in February, January and February, where you think it might be
Mark,
able to sell some wheat?
I don't have any specific price targets tonight, but I do believe there'll be some price improvement. And I'm not talking about a 25 or 30% price improvement, but something in the vicinity of 10 to 20%. And I'd use that to create minimum price or make some sales.
All right. Let's talk about the corn market as well, because there's certainly a lot of interest in that one. Like you say, a interesting report as far as the corn stocks were concerned. Apparently, we're really producing a lot of ethanol.
Near record production last week, with the expiration of the blender's credit rapidly approaching. I think that's juiced that production cycle a little bit, Mark. So we're using plenty of corn, to produce ethanol. Export sales to this point, well, they haven't been terrible. They haven't been particularly strong, and that's been a factor. And as you mentioned, domestically, the substitution of other feed ingredients for corn has taken a toll on disappearance.
All right. With that being said, Virgil, the pullback we've had in corn, will we see a similar recovery to wheat in January and February?
Well, it would be unusual if the two would diverge, but certainly the relationship between wheat futures and corn futures can change, Mark. We've had about a 6 or 7 month period here where corn has in fact traded well above wheat futures. So certainly just a change in the spread relationship could bring wheat futures higher and leave corn relatively flat. But I think there will be some price improvement in corn as well. Again, I can't divorce myself from the weather concerns that at least I have with regards to the conditions here in the U.S., and there is still concern and a genuine risk of the La Nina event having some effect on production in the southern hemisphere.
And that's going to continue to be a concern through the growing season. There's been a lot of acreage estimates out there on corn. Virgil, what, 94.5 and 95 million acres? Are you in that camp?
I've heard that numerous times, Mark. Again, I think the rationale behind that projection is a lot of last year's abandoned acreage will in fact be sown to something this crop season, and corn is a candidate, as well as some CRP acres perhaps coming into play. The one common barometer that we can kind of watch routinely is that ratio between new crop soybean futures and new crop corn futures, and at this point, Mark, it's encouraging more corn acres than not. So somewhere in that 93 to 95 million acre estimate is rational.
All right. I'm hearing a lot of comments that there's still a lot of farmer-held corn at this point, which is kind of scary because we had some pretty good prices in August. Yeah. But a lot of people are concerned about what that crop was actually going to turn out to be. So not totally unheard of. But with all that corn sitting out there, Virgil, and some of the acreage issues, we're going to need some kind of a weather phenomenon to get things going. But as we look at where corn prices are as we sit here tonight and we look at what's happening out in 2012, where we've also seen some weakness, what are you telling producers for next year?
Well, I think a lot of them, Mark, first of all, have as strong a balance sheet as they've ever had. So the notion of them needing to generate cash at the turn of the calendar is probably pretty debatable. I think they'll hold that grain for an extended period of time. One, with regards to the weather concerns that have taken shape, and two, I think the demand, at least as measured by the stocks-to-use ratio, and I'll refer both to the U.S. and the global or the world, when you look at those and use those as kind of a proxy for supply and compare those to years past, they're not large, Mark. They're relatively small. So the margin for a crop shortfall globally or here in the U.S. is small. And as a result, that risk, in my opinion, should prompt some continued strong demand beneath this corn market, both domestically as well as internationally.
So you're in no hurry to sell next year's corn?
Well, Mark, gosh, I got to believe that a lot of them have sold and made sales, and what's left is perhaps the grain that they oftentimes will kind of gamble with, for lack of a better term. And as mentioned, their debt-to-asset ratios are as good as they've been in many, many years. I just don't think there's a real concern for the need of cash right now. And with 2 or 3 genuine risks yet looming, I think they're going to be pretty strong holders of that grain. for extended periods of time.
All right, let's talk about soybeans. You said USDA's report was a little bit friendlier there.
Well, not particularly in soybeans, Mark. I thought it was most constructive to the corn market. Beans, they increased U.S. carryout by 25 or 30 million bushel, reduced exports, reduced crush modestly. Internationally, they did increase ending stocks modestly, Mark. So it does continue to suggest that soybean supplies globally, particularly with the prospect and the possibility of a pretty sizable crop in the southern hemisphere, are fully adequate. Now, that doesn't eliminate the risk of weather concerns yet developing in South America and Argentina. And as mentioned, there are some areas beginning to get fairly dry. So I think we'll hear more about that, the balance of this year into the first part of next year. If you've not made a sale to this point in time, then clearly you're on guard here and fully alerted that any kind of a 30 to 50 cent rally, you better do something, even if it's just create a minimum price, Mark.
All right.
And that's what I'd do in new crop. I wouldn't finalize any price at this point in the calendar.
All right, and you mentioned La Nina several times, and that's a big concern out there. Big concern about the dry weather that's been experienced in big parts of the Corn Belt too.
Yeah, I think that's true, Mark, and all one needs to do is look at the most recent U.S. drought index, and it's fully documented. It's a genuine concern.
You can sure see it. And also, Virgil, when it comes to terms of making sales, you're looking for that rally to sell old crop. Are you interested in all and any new crop coverage for 2012?
Mark, at this point in the calendar, I'll continue to suggest the minimum price. I still feel there are genuine production risks that will yet need to be factored into the marketplace and I think provide some opportunity. So if you can cover costs and have a pretty good grip on inputs and your crop budget, I don't have any problem with creating a minimum price or some type of small percentage sale.
All right. Real quick, Virgil, the cotton market, as we sit here tonight, what do you think, where are we headed?
Cotton futures, Mark, are kind of stymied here between $90 and $100. It would be my best opinion, those who have the opportunity here to go ahead and commit themselves to selling cash because the basis is really strong. At least the way I track it, it's unusually strong. I'd take advantage of at least that strong demand signal, make a cash sale, and then replace it either with an option or some type of vertical call spread. I think leverage on your money is pretty significant here and a good opportunity in that regard.
All right. Let's move over to the livestock side of the picture. Walt Hackney with us tonight. And Walt, big sell-off in the futures market on cattle, feeder cattle, and hogs. That whole sector was under some pressure. Is there a fundamental reason here, or is this just some other concerns happening?
I don't believe it's as much fundamental as it is loss of confidence among the traders on the board, and then subsequently filtered back to the CME. There was no fundamental reason for the Monday sell-off that we had, for instance, this week on the futures. There was no fundamental reason except the lack of confidence. And then the question is, when are they going to be able to recover, maybe even identify the lost funds that seem to be involved in that bankruptcy.
In the MF Global situation.
Yes.
So that's playing that big of a role in this market right now.
I think it had a much bigger role than any of us realize. The futures trade this year on livestock has been tenuous at best. And there's been a lot of anxiety over should I hedge, should I not hedge. Some of them, and we went ahead and we did a massive amount of hedging this year. The market maintained a better pace. It was an affirmative raise in the Merc and on the board. You couldn't really go wrong by working a hedge. Then all of a sudden that collapses in on the traders. And the traders and the identification of the lost funds simply set that market on its ear, and it hasn't fully recovered as we speak.
Yeah, it has not. Let's move on. Let's talk about the cash market and what you see happening for fed cattle here for the balance this year and head into the first quarter of 2012. Or Walter, what do you see?
Well, it's a known fact, and we've discussed it on your show here before. Inventory availability is going to become more and more limited as we get into and through the second quarter of 2012. The price of corn, the involvement of corn market into the feeding rations is going to have a great deal of effect in this trade as we go forward. Right now, the feedlots are maintaining a very manageable inventory of fed cattle, particularly when the packers are holding the kill at 650, 60,000 head of cattle a week. The feedlots are able to continue supporting that kill, but then again, they're not under delivering on the cattle. The cattle, in fact, are actually lighter progressively from month to month than they have been for a long time. Now, if corn goes to, let's use the heaven forbid figure of $4.50, $5 a bushel, if it would happen to go there, you're going to find heavier cattle. You're going to find feedlots, regardless of the profit margin they've got in these fat cattle, you're going to have feedlots overfeeding. They're going to be bullish by design, and it may not be the thing to do.
That's going to be interesting to see, and if we do hit those kinds of levels, those break-evens are going to look better, but the heavier cattle are going to be what you're going to see.
Well, Mark,
what's that going to do to us?
Well, what it will do to us until, not unless, but until beef demand improves, and we've got a sluggish, stagnant dressed beef trade nationally and internationally, and it isn't competing with the pork, and it isn't competing with the poultry. It's sitting out here on an island of its own, and really the best movement that we've had in it are on the luxury cuts, interestingly, in the high-end restaurants. The consumer is laying back on a limited budget, buying cheaper pork and cheaper poultry.
All right, well, price predictions, Virgil, or Walter, for the first quarter of next year, what do you think we're going to see?
I think you could watch where the mercantile is, and I think that would be a realistic number. I think $1.20, $1.22 would be a topside figure to expect going into next year. You ought to understand, while the Merc lost $5 a hundred last week on fed cattle, we lost $5 a hundred today on cash cattle in the feedlots.
Yeah.
So it isn't to say that we can't lose it all back if we're not very, very careful in our marketing.
All right, well, take heed, folks. Feeder cattle market and your outlook there for this calf market for spring and fall, what do you think we're going to see in 2012?
Well, as you go forward to those periods, then we're going to see a continued bullishness due to demand of feeder cattle and a limited amount of supply because of a cow herd that's sitting out there at a 50-year low. And the replacement effort by ranchers and so forth just has not and is not picking up the slack. So we're going to have an availability issue as we get into the spring. As we speak, that run of feeder cattle for this year is primarily over with. And generally speaking, the ranch calves have moved. They're at their point of destination. The yearling cattle have been moved. Very aggressive marketing, and rightly so, with the profits the producers had. They've moved those yearlings out, and it's like finding hen's teeth to get the right kind of yearlings right now.
That's always a disappointment too, hen's teeth. Talk about the hog market and where do you think we're heading there on the pork front?
Well, it would appear that there is more bearishness in the hog market as we speak. Back early on in the mid to latter part of the summer, we were having an inventory issue of finding enough hogs. As we learned, the inventory was out there, and those hogs were on the feeding floors by the more corporate or mega unit operations that were designing a heavier hog for the foreign export trade. Now that hasn't actually done all that it was intended to do, And so there's been a gradual buildup of average market weights in these hogs. Last week we were 1/2 of 1 pound heavier. Doesn't sound like much till you throw that again, 2.3 million hogs a week. So we have that issue of tonnage that we've got to be sensitive to. Packers are having no problem, as we speak, finding enough hogs to kill 430,000 head of hogs a day, possibly 180 to 190,000 hogs this Saturday. That in itself would put that kill well over 2 million head. Well, with the additional tonnage and with the ability or inability, if you will, of any of the other pork or beef and poultry commodities to really compete with cheaper pork, it's going to be hard to get that market off high center.
Well, it's going to be interesting to see price-wise. What do you think we're going to see, Walt, for hogs?
Well, I think that your issue of $92, $93 hogs, maybe $94, the potential is there. But you have to remember, we're going to set records this year on pig numbers per litter. We may not have as much expansion as a lot of people would have anticipated, with some profit that the producers are making. But we're producing a record number of pigs per litter. Some are estimating 10 pigs per litter. And you know, that's going to add market hogs to our system.
Absolutely. That's bigger than the old 1-ton litters. Walt Hackney, thank you so much. Virgil, thank you very much. We sure appreciate it. Great insights from both of you. But that'll wrap up this edition of Market to Market. Now, if you'd like more information from Walt and Virgil on where these volatile markets just may be headed, visit the Market Plus page at our website. You'll find expanded market analysis, audio podcast, streaming video of our program, and links to our Twitter feed and Facebook page. By the way, it's all free at the Market to Market website. And be sure to join us again next week when we'll examine the outlook for agricultural land values in 2012. So until then, thanks for watching. I'm Mark Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Pioneer Hybrid, working with growers to help put the right product in each field. Pioneer, science with service, delivering success.